All right, we are live, and I am excited once again. We are going to have a fantastic talk. Tonight, we have the amazing Mr. Cheston Bulgin of By the Books Consulting. He is a financial strategist, a CFO, tax strategist, and just a master at business. He's going to be talking to us tonight about tax strategy, how to determine which type of entity is right for you based on what you are looking to do with your business. If you're starting fresh, you're starting a business and you're not quite sure if you should form an LLC, a S Corp, or what you should do, if you should just stay with a sole proprietor. He's going to break that down, give you the advantages, the disadvantages, and give you a blueprint for how to approach things. So thank you for joining us.
So happy to be here. Always a pleasure to be with this beautiful, intelligent woman who just happens to be my wife.
Just happens to be, yes.
So blessed. So blessed to have you. Yeah, so this conversation, it really did help people who are not really used to being in business for themselves to decide on what to do when it comes to choosing structure, how to structure your business. Now, when we say structure business, it just means, okay, well, how's my business going to be treated? Is it going to be treated as an LLC? What does that even mean? Am I going to be a sole proprietor? What does that mean? S corps. Like, what does that mean? So I do want to keep it in the pocket of just LLC versus sole proprietorship. A lot of the people that we're speaking to tonight are going to be the people who are really deciding on how to create a new cash stream for themselves in a business. And you may have not walked into this realm before. So what I would like to do is just go over some of the things that would help this area of life make sense for you, where it has not made sense before. And I want to talk about what it is to be a sole proprietor and starting a business for yourself. That's how I want to start this conversation, and we can flow with it. Then, if you want, to just go back and forth and ask these questions about what the main premises are behind these characteristics and these categories of what people are when business and everything, so that it will make the most sense out of what the audience wants to get. But sole proprietor basically means that you are in business for yourself. You haven't done anything else but say, hey, look, you know what? I want to do this. I want to trade my service for some money, or I want to trade a product for some money. And I just want to go out here and do this with people, and you haven't done much else. So it's just you and the general public. You're going out here and making money. And with that comes an understanding of what should you be saving for taxes when it's like that, or what are the risks associated with doing it like that? What type of behavior should you have if you're operating like that? Those types of things. So if I'm a sole proprietor and I haven't created those structures, the main thing I want to consider is how am I going to get paid? Should I set up a separate account? Yes or no? How am I going to be taxed on this? Should I be setting aside a certain amount for taxes? And what should I be looking out for in terms of liability and risk and everything else? How can I protect myself? Okay. Those are some main considerations we're talking about a sole proprietor. Basically, in this realm, sole proprietorship, the main focus or main things that you want to understand rather are the fact that if you're going out here as a sole proprietor, it means that you have something called unlimited risk. It's unlimited risk is what it is. What does that mean, though? It means that whatever you do with the business, it translates to you personally. For whatever your personal assets are, whatever you have in your personal bank accounts, whatever you do in the business, all that is at risk without exception. So anything that you have, you own, your spouse may own. If you're going out here and doing business as a sole proprietor, then if anything happens, this is what unlimited risk means. If anything happens with that business you're interacting, let's say you're going out here and you're doing like delivery driving and you're getting paid $10.99 to do like delivery driving. You're doing what you maybe not you, but the person who's next to you who has another business similar to yours, they might be going out there and texting and driving, right?
Of course, none of the people
Not
listening would do that.
you. Not you. All right.
No one would do that. It must be
Let's
us.
say it's them, right? And they're doing a similar thing.
Right.
You want to have a
They're
business
doing the
like
stuff.
you, and
Yeah.
they go out to text to drive, and then all of a sudden something happens. They rear end somebody, something happens, and there's an accident. Well, everything that is in your personal business would be, oh yeah, that would never be Eugene. Everything is in everything that you have in your personal name, and your spouse, if you're married, will also be on the table for lawsuits. And that's the big difference when you're going out here and have unlimited exposure to risk through sole proprietorship, right? You could, and from the tax perspective, the other side of that is that There's something that you deal with called self-employment tax on all of your earnings, like net earnings. Like, so if you have a net income, what that means is that you have an additional FICA tax associated with your income that has to be accounted for. And what that looks like is 15.3% of that net profit is going to be due and payable to Uncle Sam. I'm talking about, well, you still have your ordinary income tax. Like if you're in a 12% bracket, 22% bracket, you're still going to have that. But on top of that, you'll have that 15.3% to contend with if you're a sole proprietor. Those are the two things that you want to consider if you're just going out here getting started with your own business and you haven't set up a structure, you're going out there by yourself and you're operating with the general public. Those are the two main considerations that you want to address.
Yeah. And I'm taking notes because I didn't know this. I'm learning something right now. So again, like I automatically thought, because I have always done the LLC structure myself, that as a sole proprietor, a person should still have a separate bank account. But
Mhm.
that's not necessary if a person is a sole proprietor?
All that money in your business is yours. It's always good practice to have a separate bank account, though, right? Even if you're a sole proprietor, it is always good practice to have a separate bank account because you can monitor. Well, if I'm going out here and I owe the government 15.3% of my net profits, well, what is that really? If you mix it in with everything else, you won't be clear on what those numbers are. You may think you owe more than what you do. When it comes tax time, you will start reporting, okay, well, I got a 1099 from these people, so this is what I owe taxes on, my 1099. But you haven't gone through the steps to put your business income in a separate business account to track, well, what did it cost you to make that money? Right? So it's only on the net profit that you're paying self-employment tax on. It's not on the gross, it's on the net. A separate bank account is ideal for anyone getting in business at any level.
Now, I wanna put a something in there because I heard something that really I hope people heard and understand. You said, what does it cost for you to make that money?
Yeah.
That is that is something that I want everybody to really pay attention to, because when you're first starting a business, and you're used to a W-2 type of income, you're used to at the end of the year, you at the beginning of the year or whatever, you go to your HR person, you put in your paperwork so you know how
Mhm.
many exemptions you claim in, and then you're expecting that, when it comes tax time, you'll probably get a refund. I've spoken with a lot of people that get really nervous about self-employment because they get worried, like, I'm gonna have to pay taxes.
Yeah.
What I want to reiterate, and I think sometimes people forget, is that you're always paying taxes. You're paying taxes all year long. What are they doing? They're just giving you back the money that they made interest on all year, is
Right.
basically what happened.
Gotta give
And they've
interest as
convinced
well.
us that, we're winning because we're getting a refund. It's like, no, actually, that's the money you should have been able to access throughout the year. But that's another story. But piggybacking on what you said, I think that's really important to stress, that there is a cost to potential, if you're self-employed and you're, let's just say, doing gig work, there's a cost to making whatever money that you make. Can you kind of expand on that a little bit, like just for understanding, so people
Yeah, so count the
have.
costs. People are not really present to all of the costs associated with it if you don't have a separate way of tracking it. And even if you do have a separate way of tracking it, there are some things that you may be leaving on the table. Like, for instance, there's mileage that you're using on your vehicle if you're doing gig work. Are you tracking the mileage? Because there's a cost associated with wear and tear on the vehicle. If you own the vehicle, like something called depreciation on that vehicle, are you really accounting for all those costs to go against what income you're making so that you're not overstating what you made inside of your business so that you have an overspending in taxes more so than what you should be paying? There are, deductions for if you're starting your business out of your home, well, your home is utilizing certain resources for that business. And though that's a cost associated with it, which actually reduces the overall net income of that business. So you're not paying so much in taxes on an overstatement of those profits, of those earnings and the income of that business. There's insurance costs and there's administrative costs. There's, computer and software costs and all
Well,
these other things.
Question for you. Can they take advantage fully of that by being just a sole proprietor?
They absolutely can. Right? If you're going to be a sole proprietor, like one of the main reasons that we want to be in business is because it puts us into this realm of control. So I got what you said about people fearing tax time. I'm going to owe this money in taxes because I have a business, right? But if we look at it, the only reason that that's the case is because you haven't really fully embraced business ownership yet. Because business ownership is designed for you to have your money throughout the year, right? Spend it first and then pay taxes on what's left over, right? Which is a whole different ballgame, right? Because before, if you're just somebody who's working a job, a W-2, you work, the government takes their money first, then you get paid what's left over, and that's what you spend to live on, all right? It's a completely different ballgame. You're getting taxed on more money as a W-2 earner than you're getting taxed as a business owner. And if you're doing the job the way that it's intended, you have more control, more flexibility as a business owner. It's just that the discipline wants to be there to have the structures in place that we're talking about right now. All right. So definitely separate bank account. All right. And yeah, you can definitely take advantage if you're a sole proprietor of all these deductions. That's one of the main reasons for you getting into business is to be able to take advantage of things that you would not normally be able to deduct, like for instance, the code is such for now, like you really can't take any deduction for any of your household expenses, right? It's not, and you can take deductions for your mortgage interest if that is more so than the standard deduction that they already give you. But if your mortgage interest and your taxes on your property and all these other personally deductible expenses that would typically be deductible on your tax return are not greater than what they have claimed to be the standard deduction, which is like right now for a married couple is like $31,500. So imagine that you would have to have more than $31,500 in mortgage interest and taxes and charitable contributions and all that other stuff in order to take deductions for that, for you to benefit from that anyway. All right, and you would only benefit to the degree that it would exceed the standard deduction. All right, because they're already giving you 31,500. So the other benefit that you would have is just that whatever the difference is, tax wise. With a business, it's a game changer because those things that would not normally be deductible, now they are deductible, like your vehicle, like your, even if you're taking a standard deduction, you can still deduct the mortgage interest because that business expense is associated with the proportion that it takes up in the house for the mortgage
What
interest,
about rent?
right? The same way, right? So if you're paying rent for like an apartment and you have a dedicated space to where you have your home office in that apartment, then that portion is deductible now, where it wasn't deductible before. Okay. So that's one of the main benefits of being in business for yourself. You can take that which was not deductible and now it becomes deductible and you're optimized when it comes to taxes now, right? Because you get to get your money, spend it, and then pay taxes on what's left over. And you're spending it on some things that you would normally spend it on just through the normal day-to-day things of your life that you would not have been able to deduct otherwise if you did not have that business. Okay. So that's one of the main benefits of being in any type of business for yourself, even a sole proprietorship.
Now, let me ask you this. As a sole proprietor, I have, and I'm asking questions because I don't know, and probably some people in the audience don't know. When it comes to being a sole proprietor, you don't really have to file anything. It's just like basically if you started working, let's just say a gig work like a Uber or something like that, they pay you directly and they pay you in your name. So you don't have to do any type of filing or anything like that. The only thing that would happen is when it comes tax time, you just are keeping your records throughout the year of, your business expenses. You have your 1099 of what you've earned, and then you're able to write off the expenses based on that. Is that
Yeah,
correct?
yeah. Well, you do have to file something. It's not like you don't file anything at all. It's just that when you're a sole proprietor, it's not an extra return for that business that you would have to file. Whereas if you were a corporation, then they have a separate return altogether for a corporation.
Well, I mean, when I say you don't have to file anything, I mean you don't have to go register yourself as a business, and you're a sole proprietor, so they're paying you directly. You don't have to file any paperwork to become a sole proprietor.
Well, it depends, okay? Because we're going to get into like little business licensing and everything else. If you're going out here and you're just doing business and you're collecting money in your personal name, you don't necessarily have to file anything with the Secretary of State. If you don't have another name that you're using for your business, right? If it's just you, okay? You can be a sole proprietor with a fictitious name. So like a trade name or something like that. And then you'll want to file for that. And there's a cost associated with filing that in your particular state. Okay. Also, what I want us to be present to is the fact that if you are going out here and doing business as a sole proprietor, you want to still treat it like a regular business, like a real business. Like, what's your plan? Like, how are you going to operate it? Like, what are your main revenue streams? What do you project that you're going to make in the first year? What are you going to do to make that? Like those types of things. It'll go a long way with you legitimizing your business so that when you're ready to step up the game and create like an LLC or something else, you'll just be ready to go seamlessly into that format. And you also set yourself up to win when it comes to business performance, right? So business performance means that, okay, yeah, I'm going to actually make money and I'm going to keep money, right? That's the idea. But you don't necessarily have to file if you're just going out in your own name and receiving money. You'll receive a 1099 from any of those gig working places, and you would still take that and put that on your individual tax return on a Schedule C. So Schedule Cs are supporting whatever business activity that you had along with your individual tax return. Does that make sense?
Definitely.
Yeah. Yeah. So the other thing I would say about that is we talked about LLCs in the beginning, and I want to start getting us into the realm of protection for one. And then like, what does that mean? Like tax wise? Number two, the main reasons that we set up these companies is for protection. That's number one reason. For an LLC, really, that's the sole purpose of that body in and of itself. Tax wise, it doesn't have any treatment whatsoever. Okay. So yeah, go ahead, ask the
Yeah,
question.
I think that may be surprising to some people. I think a lot of conversation is had where people are, like, hey, I'm going to file LLC so I can save on taxes. But that is not necessarily the case unless it is a specific type of LLC. So, can you explain a little bit about what the difference is, or why there's no tax advantage?
Yeah, because LLC is what they call a disregarded entity in terms of like the IRS. And basically what that means is like, okay, I see you have an LLC. That doesn't mean anything to me. That's how the IRS will look at it. And for me, for my job, for my role is for tax, it means absolutely nothing. Okay. So it's like putting the X-ray lens on the structure to see through to what that structure looks like underneath. So if it's one person in that LLC, they'll say, oh, that's a sole proprietorship. I got you. Right. And they're going to treat you tax-wise as a sole proprietor. If there's two members in the LLC, well, oh, we're going to treat you like a partnership. That's what they're going to say by default. All right. So it's kind of disregarding the body of the LLC to look through it to see exactly what the setup is underneath it. And that's how they're going to treat you tax-wise. The thing about LLCs, though, is it's very flexible. You can choose with an LLC how you want to be taxed. Even though there's a default treatment, you can say, well, I don't want to be treated like a sole proprietor. I want to be treated like an S Corp. I want to be treated like a C Corp, tax-wise. You can do that with an LLC.
Okay, you're going to have to break down what that means. So, what is a S corp?
Yeah, S Corps are pretty cool, right? You don't have that 15.3% tax that you're subjected to as just a sole proprietor for your net income. Well, we get to do away with that. We don't have to pay that anymore. Imagine that. So let's say you generate $100,000 in net earnings, net profits. You're like, man, it was great, but I have all these expenses going along with my living, and I have to use my $100,000. I would hate to have to pay another $15,300 in taxes because I'm treated as a sole proprietor. All right. So you can actually structure it for an S Corp, subchapter S, a classification, which says that, okay, the net earnings are actually treated as passive income, not earned income. Here's the difference, okay? Anytime you go out here and earn income, there's something that we have to deal with called FICA, Social Security and Medicare. All right. So you'll see that silent partner called FICA on your due paycheck every single time. It's like, man, why do they keep getting the cut? Who is this silent partner
Who are
called
these
FICA?
guys?
So you'll see that, like, you'll pay one side of that as somebody who's working for somebody else. So if you look at your paycheck and detail it, and you'll see federal income tax withholdings, one bucket. You'll see Social Security bucket, another bucket. This is the FICA portion. and Medicare is the other FICA portion. So you're paying half of that as a W-2 employee, okay? And your employer pays the other half of that. So basically, as an employee, you're paying 7.625%, and your employer is paying the other 7.625% of that tax burden. But what happens is if you're somebody who's in business for themselves, you become the employer and the employee, like we're going out here and earning income, okay? So the government still wants their cut of that, whether you're working for somebody else and paying half of it, or you're just working for yourself, and now you have the whole bucket of that, okay? S corps are different because you don't have to be treated like earned income. So it's all like the net earnings get to be passive income, which is not subject to that. Just imagine like your real estate income is a passive income source, okay? Same thing. If I go out here and buy stocks and earn like dividends on stocks, almost a similar treatment to that, right? Where you're not paying any FICA tax on that because you're not earning the income. It's like it's something that it just comes to you regardless of whether or not you go out here and trade time for dollars or services for money. So the subchapter S says, well, I don't have to pay that 15.3% on your earnings anymore. Huge deal. Right? And that's why S corps are so cool, because a lot of people get into them to make sure they're not going to pay that extra tax. The more money you make, get this, the more money you make, the higher you pay in taxes. So if you made $200,000, you're paying the max amount that you can possibly pay in self-employment tax if you didn't have the structure. So S corps allow you to shield yourself from that, and there's a caveat to it. You still have to pay some of that money, like FICA tax, self-employment tax, through what they call a reasonable compensation. All right, so you have to have a reasonable compensation to anybody who's an officer of that company, somebody who's working in that company and has an active role in that company as an owner, or more than we call it 2% shareholder. It gets to have reasonable compensation to the officers. So basically what that means, you have to pay yourself paycheck through payroll, and that portion there is subjected to that 15.3%. You'll see it like on the paycheck, you'll see the same thing that you would see in a regular paycheck.
Okay, you're talking to the layperson that is, and my eyes are starting to glaze like, oh my gosh, this is a lot. I
Yeah.
got you. So the root of what they need to understand is that when you get into a S corp, you're getting rid of that additional self-employment tax, the 15.3%, but the caveat is that now you're no longer the employee, you're the employer. That's how they're viewing you. So need to, or am I saying
You're
that right?
both. You're both. As a sole proprietor,
Okay.
you're not an employee. You are the business owner, and all that money is yours. And all that money is subject to self-employment tax. As an S corp is a hybrid, right?
Right.
And now you're the owner and you get to be an employee. Okay.
Okay.
Yep.
So you're saying, so basically, as the employee, I'm not getting taxed anymore, but as the employer, I still am getting taxed. Is that correct?
As the employer, you're not getting that 15.3% tax. As the
Okay.
employee, you're paying that 7.25% on the employee side, and the employer is paying that 7.625% for whatever the wages that you get paid through the S corp, which is less money than the total profits that you would gain from that structure. An example would be, all right, so let's say you didn't generate $100,000. If you were a sole proprietor, you'd pay $15,300 on that $100,000 if you made it. Now, if you're an S corp and you generate $100,000, let's say you put $35,000 as a wage, you'd only be paying the self-employment tax on $35,000 as opposed to the whole $100,000, right? $65,000 would put you at somewhere around about $9,000 of tax savings on that. Okay, somewhere between $9,000 and $10,000 of tax savings that you wouldn't have otherwise if you didn't have that structure. Main benefit of that. So if you're thinking about it, people who are generating enough income inside their business, it would make sense for them to make the leap to an S corp because the more the money they make, the more money they're saving in taxes.
Chill. So let's talk about a C corp. What exactly is that?
Yeah, C corps, they're interesting. They're very interesting structures. And I don't recommend them a lot for small businesses because it does take some lining up with behavior to have it work for you. But C corps are completely separate when it comes to taxes. So you have something called double taxation that you could face with a C corp because of that. if I'm going out here and I form a C Corp differently than all these other entities, like the money, it belongs to the owner of the business. Like for an S Corp, we call it pass-through income, right? So the income actually belongs to the shareholders. S Corp doesn't pay taxes at the corporate level. All the money there is going to flow through to the owner through a Schedule K-1 is what they call that. It's going to go on your tax return to be handled at the individual level. So if you have multiple owners on that S Corp, each shareholder would get that K-1 and it would translate to their individual return and they would pay taxes at that level, and that's it. One time, deal with the taxes. C Corp, different story altogether. 21% flat tax rate on C Corps federally. That income is not associated with the owner at all. The only time that income gets associated with the owner is if the owner actually takes money out of that C Corp.
Gotcha.
So
Okay.
if I take a wage, well, I get taxed on the paycheck that I receive. I get a W-2. If I take money out of that, like from the profits, well, they call it a dividend. You get taxed on the dividend. But the C Corp, you get taxed at that 21% rate, and then you get taxed again if you take money out of that at the individual level, right? That's the main difference between taxation for a C Corp. But they're pretty cool because if you are somebody who's a growing business, like if you've grown to the point to where you're like, man, I don't want to be taxed on all the, because for example, S Corps, it doesn't matter whether or not you take the money out of the S Corp, you're still going to be taxed on the earnings of that S Corp. Okay. So whatever the profits are, you pay taxes on it. And you're going to pay taxes on it at whatever your ordinary income tax rate is. Okay. So that's the thing with S Corps, like you can't escape it, right? Let's say that you have made, you're grossing, you're netting in that business $750,000. It puts you at the highest tax bracket. You're at 39%, right? So the S Corp is subject to all of that income is always subject to that 39% of taxes. It's like, well, I don't want to pay all that.
Right.
But C Corps have a flat rate of 21%. So if I'm not taking the money out of it, well, guess what? I cap my tax bracket at 21% instead of 39%. So it makes sense, right?
Okay. Yeah, this is let me just for anyone who was wondering, this is not wine, this is kombucha. So I need to take my swig of
We're doing our red table talk. That is wine. No, listen to her.
this is kombucha. This is not wine. But I need to take a swig of kombucha on that because that's
High level
it's a
stuff.
lot.
Yeah.
This
level
is,
stuff.
and
Yeah.
I got to tell you people, Cheston is a man who eats, sleeps, and drinks, financial management, taxes, all that stuff. His leisure reading is like tax code, like books like this. Is like, I walk in the room, he's like flipping, just like, hey, So this is stuff that he masters and really studies. And, for your average person, or let me not say for your average person, for a lot of people, yeah, we definitely appreciate his brain. He has, he forgets more than what I know. I'll put it like that. But I will say this, for the majority of the people that are probably watching this and that are within the retirement replace community, a lot of these people are people who either are starting their entrepreneurship journey. These are people that are feeling like they want to accelerate their retirement goals. Maybe they're not prepared in the fashion that they like to be, or they feel like they just are not completely not prepared for retirement, and they're looking for to develop income streams to replace their income. So I think many people are probably either not going to be experienced entrepreneurs. This might be their first business, or they're kind of exploring different options. So based on that, for somebody who is like brand new to entrepreneurship, maybe they are working a W-2 job, they're going to, right now, one of the things that we've been talking a lot about is creating your own app. And that's something that, somebody could do and start charging a monthly amount and create a recurring income. So something that they can do on the side while they still work their 9-to-5 job. What kind of structure would you suggest for somebody like that? Is it dependent on the amount of income that they're earning over the course of a year, or what would you recommend for somebody like that?
I would always recommend to get an LLC started, mainly for protection. You can go ahead and get insurance like liability coverage for your business, which is something you should always do. Is get liability coverage for your business. Even though you have that liability coverage, it's always good to have an LLC or some type of business structure started to protect the business activity from the personal life. So if you do something in business where somebody's upset about whatever you do in business and they want to come after you, you're protected to whatever's in that business. Nothing more outside of that business is at risk. Okay. That's why I recommend doing the LLC and treating it like that. Because if you don't treat it like an LLC, it still won't do the protection for you either. It has to be structured that way and it wants to behave that way for you to get the full protection.
So explain, what do you mean when behave that way? What does that mean? What do you mean by
Yeah,
that?
so operating agreement, right? So you want to have an operating agreement for your LLC, which is basically an outline of how you're going to run that business. Okay. What are the rules of the game for your business? Get that established for it and then make sure you're operating within that operating agreement. Separate bank account, no commingling, which is when people use their business funds for personal stuff. See it all the time. See it all the time. All right. But if people don't understand what's at risk when they're doing that, I have an inherent understanding of the company I have is called By the Books, right? And so I don't like looking over my shoulder for anything at all because I like to do things by the book for that purpose to make sure that there's peace of mind inside of what we do. And one of the main things that I'm present to is if I am spending the time investing the money into a structure, I want it to actually do what it's supposed to do 100%. I don't want any flaws in that. So one of the things that would create a huge gaping hole in the structure of your LLC would be you taking money from the business that you've created under that LLC and using it directly for personal things. All right. And so you have
What? I can't go shopping and I can't
well,
I
it was
can't
like it's like you made that LLC just about as worthy as toilet paper, right? You can do it. It's just like the LLC is not going to do what it's designed to do anymore, right?
okay.
And when it comes to it, so that's one of the things that I would recommend for people to
So
do.
let's clarify that. So let's just say this person is, they got a side hustle going. They're making, maybe $500 to $1,000 a month. And that money that's coming into their business, they're looking to, invest it or use it to pay down debt or, maybe some bills or something like that. What is the best way for them to still get that tax savings and protection, but also be able to use it for those type of purposes?
Yeah, there's a couple of things that you said there that are really cool. Like investment was the first thing that came out of you, which is awesome because if you think about a business, it's actually a separate being. If we look at it as a separate being, like that's the entity classification, something separate than you. It has its own life, really, in terms of finances and everything else. You could use that business to invest in its own investments and be good there, and it could grow inside that company. Or the second part of what you said was, well, how do I use that money for my own personal reasons? So how do I get money out of the business? I'm taking all my time here to do this business so that I can have extra money for me. Well, how do I get access to it? Well, we do something called a draw or a distribution. So a similar thing is that we take money from that business and either we cut ourselves a check, that's a draw check, and we deposit that money into our personal account and handle all of our personal expenses at the personal level after we've taken that money out of the business. Or we can transfer money from that business as a draw or a distribution to a personal account. And then that is completely compliant with what we're up to. So we're just actually accounting for it in that way. So nobody can say that you have commingled transactions. Okay. And then you can do whatever you will at the personal level with that money. But the cool aspect of it is that you can have that business create its own investments. The thing that we think about is how much investment gets to be in that business that becomes at risk for that business. You want to limit the risk, like exposure. So if you're growing a lot of investments in that one business, it's like, okay, now I'm dealing with all the public. Everything that I've built in this business is in that one umbrella. I might not want all of that to be at risk, right?
Right.
As it
Somebody
grows.
sues you or something
So
happens.
we want to have a strategy for that too as that happens. But if you're somebody who's just getting started, keep it simple. Form an LLC. Get your liability insurance. Get your business bank account. Start recording everything from the business level. Right. Make sure you have your operating agreement. You're abiding by that, and you're going to be good to go. Have your quarterly or biannual or annual meetings, and you'll be good to go. So that's behaving like the business.
Yeah, I think we're gonna need to have you come in and train people on this. We, some of this stuff, I think a lot of times people, understand how to file their LLC, with the state. That's pretty, straightforward. But a lot of times people are not going through the steps of putting together an operating agreement and having those annual meetings, that type of thing, just so that they're fully compliant. So that's an important part of, this whole process for
Yeah.
sure.
Yeah.
Yeah. But also piggybacking on that, what I'm also left with is that it's extremely important to understand how to manage your books as a sole proprietor, or as sole proprietor or LLC. You need to learn how to manage your books so that you are not only being compliant, but you're also maximizing your ability to write things off at the end of the year. So, can you talk to that principle and why that's important and what people just maybe a little snapshot of what people should know about that?
Yeah. Gene has a question in chat. I'll answer that first, and then we'll get into that because she has a question that's really common, like that people think about too. It's like she says, we set up an LLC for we set up an LLC for the real estate and it's the real estate operation, and I like to work a side hustle to bring bills down. Should I create an LLC offshoot for the side hustle? Yeah, like it like depends on how much your risk appetite is. Okay, because you can go and do a side hustle and you don't have to have an LLC. You'll be a sole proprietor separate from the real estate. It's not the same thing. Okay, I want to be clear on that. And you don't necessarily have to set up an LLC. You just want to understand what you're getting yourself into. You will have the risk exposure. And if you're doing the side hustle to a large degree, you might not want to have that full risk associated with you doing that in the public because now everything that you have, even the other real estate business is now at risk because it's just you. Just look at it conversely too. If I'm out here and operating personally and I get an accident or I have an accident with somebody or get into altercation with somebody and now somebody wants to sue me personally, that's a whole nother realm altogether. Everything that I own, including my businesses, my stake in my businesses, will be at risk. So if I have a stake ownership in a partnership, well, my partnership interest will be at risk for what I did lawsuit wise. So we want to make sure that because if you're operating as a sole proprietorship, that's what would happen too with the real estate. That becomes at risk as well. All right. So you want to just go in with eyes wide open with the amount of risk exposure you're willing to tolerate when you're doing a side hustle. Okay. All right. So it's super important to understand the business itself has a purpose. And this is what we actually want people to be clear on. Like, what is the designation for the activity? Like, what activity is falling into this business? So if you have a designated like activity like real estate, is it going to be rental real estate? Is it going to be fix and flips? Two different types of business models. And that in itself could warrant two different businesses, right? Because the fix and flip is earned income. And a whole nother treatment that we need to have for that. Like, is it going to be an S Corp? Is it going to be a C Corp? Because you're dealing with earned income now. If you're doing rentals, well, you don't have to. I mean, it's passive income. Well, we can just leave it as a real.
So let's clarify that. So let's just point out what the difference. Let's clarify the difference between earned income and what were we talking about? Earned
Passive,
income and
passive.
passive. Yeah, yeah. So explain the difference between these two.
Yeah. So earned income means I'm going out here and trading my services for money. That's what
Okay.
earned income is. Or like I'm selling a product or I'm providing a service for somebody directly. It's an active business, right? That's earned income.
So let's just say in the real estate game, that would be like wholesaling?
Yep, wholesaling. Like I buy properties and I'm not even buying them. I'm just going in there and negotiating deals, and I get like the finder's fee for that, right? To get it. So that's also like a service that you're providing. So that's earned income. That's a whole different tax structure because it's on the earned side of the equation, right? So we got to handle that differently, handle it distinctly than if it were
Okay.
just you doing rentals.
Okay. The rental would be considered passive income?
Yep. Yep. We consider passive income. And it's pretty cool with real estate. There's some other things with that can actually help tax wise, but mainly it's not subject to that self-employment tax.
So why would that be considered passive?
Rental?
Yeah, because if they're paying me monthly, I mean,
Yeah. They're paying you monthly, but you're not actually actively doing anything for them to pay you monthly. It's just that they're using some of the space that you have. And because they're using the space that you have, they're paying you money for the space that you have. You're not going there and providing the service for them directly for them to pay you for a specific service. Now, if you were in that rental and you provided like concierge things and you're actually doing things for them physically, like actively involved with it, that's a different story altogether. Now that becomes an earned income type thing. But real estate is so cool that we have ways around it being treated like that all the way, even if you're doing things like concierge service. Real estate by designation is something we call a passive income source because people are going to pay you just for the fact that they're living in the building or using that property. It's not, you can actually sleep and still make money from that.
Right. So this is good because I'm learning. I'm learning. I love to learn all this stuff, picking your brain. So would the car rental business that we have, is that considered passive income or is that
Unfortunately, no, it's not
hmm,
because there's an activity of doing that. Inside the car rentals, it's treated like sales is what it's treated like. It's treated like inventory and sales for the rental. And basically because there's an operational component of it. So when I say operating component, these are things that we're looking for in terms of like how it's going to be treated for tax purposes. Like if I have to go out there and build a whole operation to provide the service for people, then I've stepped into the realms of active earned income. So I have to go out there and I'm marketing the rental of the vehicle. And I have to go out there and I have to make sure I'm inspecting the vehicle and I'm taking the keys, I'm turning them over to somebody each and every time that somebody's renting the vehicle, right? So it's like it's me being heavily involved in that process. I'm actively involved in that process. I'm doing a service. I got to go out here and make sure I'm maintaining the cars, fuel up these cars, and all these other stuff that goes on in the background with running that operation. Right? There's a heavy activity involved with that. Right? Whereas if I'm just doing real estate, I can manage the properties kind of passively. Right? Like and still have like all these people pay me rent. Like they're gonna because they're living there, and it's like gonna be month to month to month for a whole year without me having to resell that or anything like that. That's actually a passive treatment that we're associated with it.
so would a like a shared housing, would that qualify as passive or would that still be active?
And because it's real estate, they can get away with it being passive treatment. They're paying weekly rentals too, right? So it's like similar to like if you're paying monthly rentals, it's all considered the passive realm. Real estate has its own designation for the tax code.
Okay.
So as long as it's like you're having or like a real property and you're getting paid what we call rents for real property, it puts you in the realm of passive income. Just as if somebody were going to pay you royalties from a book. Like you've written the
Okay.
book, but you get royalties from that book consistently, persistently throughout the years, right? You're not going and doing anything else to make that money. It's just being paid to you year over year over year. That's the same type of income.
Curious, would storage units be considered?
Yeah, if you own the storage units and you're getting paid, like and you're actually getting rentals for the storage units, that is a passive income. Yeah,
So the way that it gets treated, you're at a lesser tax bracket than if you were doing active income.
it's not a tax bracket thing, but it's more so treatment thing. Like it's not self-employed type income. We're not treating it as earned income, so it's not subject to the self-employment tax.
Okay, got it.
And this is the strategic consideration that we do with people to help them understand the impact of it, right? So you're going to pay if they're going to structure themselves in certain ways and end up paying a whole lot more money with some of these structures because of it. It's a more of a higher level conversation for I think the people that are looking to get into business. But once you get in and you get your foothold into what you're doing, like if you're starting out, you're probably not going to make a whole lot of money the first year. You most likely you'll want to have cash flow and lose money in the first year, if possible. Different talk altogether how to.
Lose money. Explain that. Have cash flow and lose money.
Yeah. So, for instance, let's take this car rental business that we have. So we invest in cars and everything else, and then we start making money. If thousands of dollars a month is coming in cash-wise, it's positive cash flow, right? But on the tax return, we lose money because we have all these assets and everything else, right? And all these other expenses. And so we can write that off, but we still have the positive cash flow from the business coming in,
Too.
right?
Okay.
So it's like a paper
I
loss,
like
but
that.
yeah, and that's why real estate is so good too, because you can do the same thing, all right?
Right.
But in overall, as your business grows from year to year, we start looking at different types of structures to move into because you're not going to have that anymore. You're just going to have profits to deal with, and not have it offset by all the deductions and everything else. What do we do with that in terms of shifting the different tax brackets and all this other stuff that we get to do? Maybe you have kids, and well, how do we bring them into the equation and start paying the kids? Because you already have money that you're spending on your kids. Work in the business, earn their keep, right? And then
Right. Put them kids to
and
work.
to pay that off instead of just buying all the stuff for them outright without deducting it. So there are other things to consider with that as people grow and start having more money inside of their businesses. How do we structure it differently? How do we move into these different realms? But for people that are starting out and they just really want to get a foothold in, the basic thing is to make sure, like my main recommendation for a lot of people, for most people, it might not be everybody, but for most people, get that LLC set up and then make sure you get your separate bank account, make sure you have your operating agreement, make sure you're doing your annual meetings, and then you're good to go. All right. And then you asked a question about bookkeeping and everything else and how to keep track of everything. So one of the main things that we do for a lot of the businesses that we work with is make sure that we are tracking all the finances for the business, right? We look to get 100% of the truth in the financial reporting. It's easier to do when you're smaller than it is when you grow. You want to have a structure in place to make sure that you're able to track all the ins and outs of the business. Okay. How much did you spend for advertising? How much did you spend for maintenance? How much did you spend for vehicle expenses? How much did you spend for insurance costs? How much did you spend for labor? How much did you spend for software coverage? Like all that wants to be tracked distinctly so that when it comes to you, number one purpose is making sound decisions on the business. Is it doing well? Is it not doing well? Is it helping me or is it hurting me? Right. So you want to be able to see that and make those adjustments. All right. You also want to see, okay, we have different units of revenue that come in. Like, for example, at By the Books Consulting, we have different revenue streams. So we have, the tax revenue stream, we have the advisory revenue stream, we have the monthly recurring revenue stream for people that are in high level advisory consistently and reliably. We have a revenue stream for like basic bookkeeping and everything else. So we have these multiple revenue streams inside the company that we track distinctly so we know how each one is performing, right? So you want to be able to distinguish that through a bookkeeping process and have those structures in place to determine, okay, what does good look like for my business? Are we doing good here? All right, that's number one. And then also it makes it easy come tax time. So you can have a high level conversation with whoever your tax professional is. And you can bring some really good questions to them. Some people are like that with me. I mean, I love that when they come and they have some really great high level questions and we can actually play the game really, 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 really well with that, right? So just having those basics in place would help. And you could have like something like a QuickBooks. Some people just use spreadsheets. Takes a lot more work to do that. But you want to have something that's going to make it easy for you to track everything that's going in and out of your business.
Right. Well, I'm very happy that we have you as our resident specialist in the community. And we will definitely be having you on regularly to come and pick your brain, ask you questions about taxes, about bookkeeping, about strategy, all these different things, because it's important, as you start to create income streams, you need to make sure that you're not paying more taxes than you need to.
Yeah, keep more of your money in your pocket.
Keep that money
Yeah,
because the government will definitely take it if you let them. So let's keep it.
yeah,
Yeah. So what we are left with is definitely the advantages for people that are starting out, or let me not say the advantages, or the things that people should be thinking about is protection. LLC is going to give them that legal protection so that if they are operating and someone comes out and tries to sue them, they are not going to be personally liable and have all of their assets potentially at risk. They also, with both structures, it sounds like they're able to still write off things, so it's equal treatment in that regard. There is no difference in terms of taxation if a person is a single person LLC. It's pretty much treated the same. So the main advantage is going to be the protection.
yep, you got it. Let's go. All right, that's the main advantage of an LLC is the protection. The other thing is flexibility too, because you can choose how to be treated tax wise in LLC too. So that's one of those things that's there as well. If you did not have an LLC and you just went in and got it and you were just going out as a sole proprietor, there is no flexibility of changing how you're going to be treated tax wise. So LLC does present that flexibility, which is why I say just get started with that because you can change it, you can shift it to whatever you want, and as you grow and you get more profits, you'll still have that availability to do that from an LLC perspective for most people. So yeah, we hit it, and just make sure you're not commingling. Commingling is one of those things that people do that get them into trouble when it comes to asset protection. So the business is its own being and it has its own income, it has its own expenses, and they're not the same as your own personal expenses. So that would be the thing there too to pay attention to when business operating. Okay.
Another thing that I want to mention that I think it's actually somewhat of a recent change because many years ago this wasn't necessarily the case. But when you are filing your LLC, you want to make sure that you have a separate address because nine
Yeah.
times out of 10, the bank is going to require a separate uh, they're going to require a business address or a physical address, shall I say. So even if it's your home, even if it's your residence, it needs to be a physical address. For many years, I used a post office box, and now the majority of banks do not accept that. So that's
Yeah.
something else to be aware of.
Yeah, that's really good to bring up because that is that. And there are services that you can take part in that would give you a separate address for your business. There is a cost associated with it. So you want to do your research with that. But definitely, if you're somebody who's all okay with using their personal residence for their business, you can do that. A lot of home-based businesses do that. But it also depends on your level of concern about privacy and everything else with the business. So yeah, that's
Right.
a really good consideration.
Another thing, and we will be talking about this in the coming weeks, is this is a important consideration for funding as well.
Uh-huh.
They like to see a physical business address. So something to keep in mind because when it comes time when you're looking to expand and you want to get some additional funding for your business, that's something that these companies are going to be looking at as well.
Yeah, really good. Man, that's a great conversation to have at another time
Yeah,
about
we
business
definitely
funding.
will do that.
Now you can do that with business and how you can, your DUNS number, your paydex score and all that other good stuff that you get to have to build business credit and everything else. So yeah, that'd be awesome.
Yeah, we will definitely have that conversation. There is some nuance there, and there are a lot of people online spreading a lot of misinformation. I've seen it up close. There's misinformation that's going on about how to set that up. So we'll talk about how to do things the right way, compliantly. So yeah, I'm excited about that. Any final words that you want to leave with the audience about taxation and what they should be thinking about?
Yeah, man, the best thing to do is to mind your business. That's what you get to do. I love this conversation about being a business is the best place to go when it comes to having control and freedom in life. Like if you're stepping into this realm for the first time, I have it, that's a really great pathway to take on. There's no place I'd rather be than inside of business ownership because of that freedom and flexibility and control over finances that we have. It just takes something. It takes discipline. It does take understanding like, well, if I'm going to do this, I need to understand how to protect myself a whole 100% inside of the process. Just check those boxes. So inside of the conversations that we get to have, we're talking about boxes that you get to check so that you're going to be good. Okay. So this is one of those conversations where you get to check boxes. Operating agreement, LLC, bank account, annual meetings. All right. Make sure you're tracking your expenses, no commingling. Check those boxes and you'll have a good start with what you're up to. All right.
Fantastic. Fantastic. We have just a couple of minutes. I want to open it up if anybody has any questions or anything they want to clarify about what was mentioned tonight. Feel free to type that in the chat and we can answer that. Again, if you are not currently a member of Retirement Replace, I want to invite you to become a founding member. Right now, you can actually join the community for free. However, if you want to get access to our advanced trainings, replays, all that good stuff, you definitely will want to upgrade as a premium or VIP member. We're discounted right now, heavily discounted right now. And it's a fantastic community full of like minded people who are on the same journey of not being a victim to their finances, but actually taking control and creating income streams to empower themselves, create freedom and the lifestyle that they want now and moving into retirement. So if that sounds like you, I want to invite you to come on and join us. Again, the community is retirementreplaced.com. And you can learn more and hopefully join us, and we'll be happy to have you.
Awesome.
So thank you again, Mr. Bulgin, for joining us
Yeah,
and
thank you for
sharing.
having me, Mrs. Bulger.
Yes, definitely. Yes, we're glad that you joined too, Jean. And we definitely look forward to the next session. We're going to break some more of this tax and financial stuff down. And until next time, have a good night.